Hey there, in this video I'm going to show you what I think are three of the best ETFs or exchange traded funds in Canada that, especially when combined, create an excellent, well-diversified three-fund portfolio. Now, if you're new to the channel, I have a bunch of experimental portfolios on the go where I invest real money into different asset classes to test out which has the best ROI. But these three ETFs right here make up what I'm calling my retirement portfolio that combined give me exposure to almost 8,000 companies in the US, Canada, and also around the world. So without any further ado, let me take you into Wealthsimple and show you the overall portfolio. Then I'm going to discuss each ETF, talk about why I chose it, what the percentage allocation of the portfolio is, and then discuss the overall return on investment since I started this experiment. All right, so here's the overall portfolio. You can see that it's around $1,300 right now and that I'm up around 3% in the last 3 months. Now I have around $330 that I'm going to invest today, which I'm going to do as I talk about the different ETFs. So let's start right here with XUU, which is the BlackRock Canada iShares Core S&P US Total Market Index ETF. So this ETF tracks the total US stock market, including large cap, mid cap, and small cap companies. You can see that year to date, it's up 25%, which is crazy. Scrolling down here to some key facts about this ETF, the first thing that I want to highlight is this number right here, the number of underlying holdings. Now that means that there's 3,685 different companies or stocks that make up this ETF. So it's incredibly diversified, and for a price of around $45 Canadian per share of this ETF, you get to invest in almost 4,000 companies. The dividend yield on this ETF is 0.77%, but that's not really what this ETF is about. And if you're looking for dividend paying ETFs, that's a whole other story. The focus here really is just on steady growth over time. And you can see that the management fees for this ETF is 0.07%. So it's taking a very small fraction of 1% as the fee for managing these different stock holdings. And my target allocation for this portfolio is to put 50% of my capital into this ETF. And the reason for that is pretty simple, but basically the US total market is one of the safest and most stable places to invest money that has returned a very solid ROI over a long period of time. For example, if you look at the 5-year performance here, there's a very solid and steady trend upwards. Now, that's not to say that there might not be a crash at some point in the future. And actually, I'm going to discuss what I'll do if there is a crash at the end of this video. But you can see that even after major crashes, like right here in February, March 2020, for example, with the lockdowns, it always bounces back. And in fact, if this index did not bounce back, then it would mean probably that the American economy has failed completely and the whole world is probably screwed anyways. I currently have 12 shares of this ETF and it makes up around 53% of my total portfolio. So to try and keep the allocations correct, today I'm going to purchase 3 more shares of this, and then I'm going to talk about the next ETF. All right, that's done. Now the next ETF that I'm going to talk about is VCN, which is the Vanguard FTSE Canada All Cap Index ETF. And basically, this is the same as the American one, except it invests in the total Canadian stock market. Now this ETF has a slightly lower management fee than XUU at 0.05%, and it also has a higher dividend yield, which is currently around 2.5%. Continuing down for some more details, there are 182 stocks in this ETF, and that's 182 of the largest companies in Canada. You can see that the median market cap of all the companies that make up this ETF is almost $50 billion. In terms of the sector breakdown, you can see that this ETF and the Canadian market in general is much more heavily weighted towards financials and the energy sector. If we look at the largest holdings in the portfolio in terms of specific companies, you can see that you got Shopify in there, a major tech company, but then there's a lot of banks like RBC, TD, Nova Scotia, Montreal, and you've got some energy companies like Enbridge as well. When we're looking at the performance of VCN over the last 5 years, you can see that it's not quite as good as the American stock markets, which proves the point that they don't move in lockstep. But you do want to have exposure to multiple markets and also global markets, which is why I'm including a 30% target here. If I went all in on the US market, it might be good, but it might not. You never know. And if energy sector ever actually bounces back, then Canadian stocks and the Canadian stock market could see much faster growth. I currently have 7 shares of this ETF and it's around 26% of the portfolio right now. So since I'm trying to get that to around 30%, I'm going to purchase 2 more shares of this and add it into the portfolio. All right, that's done. Now let's move to the final ETF in the portfolio, which is VIU, the Vanguard FTSE Developed All Cap X North America Index ETF. Now, what does that mean? Well, this ETF invests in developed markets worldwide, but not including the US, Canada, or also China. Right here, you can see that the vast majority of the companies that are in this ETF are listed in either Europe or the Pacific region. And in the Pacific, really that means Japan, South Korea, and Hong Kong, so no China, and then a lot of European countries in there as well. Now, I've spoken before about why I chose to include this ETF in my portfolio as opposed to some others that do include China and also emerging markets worldwide as well. But I opted for this one because of the geopolitical and pragmatic reasons that I have to not invest in China. I could do a more deep dive at some point about why I'm taking that position and why I'm willing to potentially forego some growth because there's a lot of massive explosive companies coming out of China, but I'm just not interested in holding that in my portfolio, so I'm happy to stick with this. Anyways, the management ratio for this one is slightly higher because, of course, they have to do a little bit more active management and they have to work with different stock exchanges around the world. The dividend yield here is 2.27%, and the number of stocks that you get exposure to when you invest in this ETF is 3,892. The 5-year performance here is less impressive than the US market, pretty much on par with the Canadian market. But there's a different focus here worldwide, and in order to increase my exposure and to have the maximum diversification possible with just a 3-fund portfolio, I'm adding this. And since I'm trying to allocate around 20% of the portfolio to this, and currently it's sitting at 13 with 5 shares, I'm going to purchase 3 shares of this, bring that up to 8, and hopefully I'll have a much more well-rounded and diversified portfolio. All right, so that order went through. You can see that the percentage allocation here jumped back up to close to 20%. So here I have a 3-fund portfolio that gives me access to almost 8,000 companies worldwide. It's much more heavily weighted towards North America and in particular the US, but I also have exposure to developed markets around the world. Now, the goal here is to have an investment strategy for my retirement fund that's so perfectly simple with just 3 ETFs, 3 funds that I can easily just continue to dollar cost average in every single month and build up my exposure to thousands of companies worldwide and have this incredibly broad-based and diversified investing strategy. I also did say that I would talk about what would happen if there's a market crash and what I would do here. And it's actually very simple. I just alluded to it, but I would just continue to buy in month after month. And in fact, I would be able to buy more shares for much less if there was actually a significant crash, which is perfect for someone like me who's not even close to retirement, which means I'll just be able to bring my dollar cost average way down. My cost basis would be very minimal if there was a crash, and I could continue to build up those positions over time. And statistically speaking, that is proven to be the best investing strategy. Rather than trying to save up a lump sum and time the market right after some crash, you're much better off just dollar cost averaging in over time. So no, I'm not worried about any market crashes, even if people like Michael Burry are constantly yelling that the house is on fire. And honestly, I expect that this investing strategy will be better than most of the other experimental portfolios that I've got on the go with this channel. Realistically speaking, if some of my crypto investments or my Palantir investment, for example, hit it big, then that could potentially 10x and have really monumental gains. But with this particular investing strategy, I don't have to worry about picking and choosing winners, and I also don't have to worry about bag holding some penny stock that I thought would 10x in a month. Anyways, that's the update on the retirement portfolio today, and a little explanation on why I think these 3 ETFs, especially these 3 ETFs combined, are some of the best investment vehicles in Canada. Thanks so much for watching, and if you want to continue to follow along and also check out some of my other videos about other investing strategies and what the ROI is of that, please don't forget to subscribe to the channel and drop a like down below. I'll see you in the next one.